Hey everyone, welcome back to Corporate Decoder, the place where we take complicated financial reports and turn them into something you can actually understand. Today we're diving into a municipal bond fund report, which, let me tell you, can sound about as exciting as watching paint dry. Unless you know what secrets to look for. What? A bond report interesting? Believe me. So today we are looking at Nuveen's Select Tax-Free Income Portfolios report that goes through March 31, 2025. Here's the hook. While this fund aims for safe, tax-free income, can it actually deliver in a world of rising rates and economic uncertainty? We'll break down the fund's performance, key risks, and how it all might affect your investment. If you are interested in more detailed deep divers of companies and financial reports, remember to subscribe to the channel. You will also find a Discord link in the description below, so join us there for even more discussions. Scroll Nuveen Municipal Closed End Fund Scroll. This report covers two funds. Nuveen Select Maturities Municipal Fund and the one we're focusing on, Nuveen Select Tax-Free Income Portfolio with the ticker NXP for short. This fund aims to give investors income that evades regular federal taxes because it invests in municipal bonds, called Munis for short. These are typically used by local governments to fund various projects. Let's get to the heart of the matter. How did the taxes do? For the year ending March 31, 2025, the fund returned 1.41%. Sounds okay, maybe, but the report admits that it actually underperformed compared to its benchmark, the S&P Municipal Bond Index, which returned 1.76%. So already with the big picture, we can see that the Nuveen Fund did not live up to its promises. Keep in mind, it is crucial to get proper returns versus a benchmark if people want to keep investing into something. What helped performance a little bit? Well, being underweight meaning having less of durations of 6 to 8 years. Also, overweight meaning having more allocations to A-rated and BBB rated bonds. Now, what dragged the fund down? First, being overweight to durations, meaning long periods of 8 years or longer. Also, too much investment in dedicated tax and life care sectors, while not enough in the industrial development revenue sector. Ouch! A major figure for investors is the monthly distributions. This fund paid out $0.6177 per share for the year. That translates to a market yield of 4.34% and a taxable equivalent yield of 7.33%. Basically, the fund tells us you'd need to earn 7.33 getting after tax here, assuming a combined federal and state 40 getting after tax here, assuming a combined federal and state 40 getting after tax here, assuming a combined federal and state 40 getting after tax here, assuming a combined federal and state 40.8% rate, which is just an example. Your number will differ. This part is a major selling point, trying to entice people as much as possible so they feel they are winning. Warren Buffett would probably laugh looking at this. Here's where it gets a little more complex. The fund has something called an equity shelf program that allows them to sell additional shares. In the current report of the period, they were authorized to sell 14 million maximum aggregate offering and actually sold over nearly 3 million shares through the shelf offering at a 1.71% weighted average premium to their NAV. While this brings in capital, it can also dilute the existing shareholders by a tiny number. To balance this a little bit, funds often have a repurchase program. They never used any to repurchase or retire shares. Repurchasing and retiring their shares can have a positive effect if done correctly on the stock price. Scroll portfolio credit quality chi S of total investments. So scroll, so where is the money actually going? A large chunk, 54.2%, lands in AA rated bonds, with another quarter in A rated bonds. Only a small amount is in the lower rated stuff, meaning riskier bonds. As an investor, you just need to ask yourself if it is worth it. Scroll report of independent registered gold to public accounting firm Scroll. CPPUC audited the financials and gave a thumbs up stating everything is legit in all material respects. However, it is critical. You compare year over year to see if the accounting company says the same thing always. Let's dive into the investments that NXP has. Now, the fund is all about municipal bonds. To be exact, 101% of net assets. This number can be more than 100% even because of different accounting tricks. Anyway, it is great you are completely focused on what has been promised. Geographically, California accounts for 14.8% of the municipal bond holdings, followed by Illinois 9.3% and Colorado 9.1%. So if something happened in those states, well, it's going to affect the portfolio. The fund invests in California Community Choice Financing Authority, California Revenue Bonds, California Academy, Central Valley Energy Authority, California, and all their general fund bonds are insured, which lowers the risk. The investment fund also has exposure to tobacco settlement asset-backed bonds, a rather risky investment basically. These bonds are secured by money from lawsuits against tobacco brands. However, since people are smoking less, these can fluctuate like crazy. In fact, a later statement in the report says it had to make some legal maneuver to compensate since many have fallen. A good lesson to always read each report carefully from top to bottom. Now, let's add everything up. Good long-term returns from good insured investments and pretty bad results in the past year that look questionable. Can they beat the S&P in the future? We cannot tell. It seems like they know what they are doing at a fundamental investing level. So if their portfolio can withstand the high risk of the inverse bonds and some risks that were in the past, they have a realistic shot at achieving a higher net positive after 2025, given their goals to increase tax income. We also have to see after the ongoing legal restructuring, they will be able to improve tax income. We also have to see after the ongoing legal restructuring, they will be able to improve their yields and make a profit of after 2025, given their goals to increase tax income. We also have to see after the ongoing legal restructuring, they will be able to improve their yields and make a profitable portfolio change with long-term capital gains. That's our breakdown of NXP's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.